While a lot of attention for investors goes to capital growth, dividends are a great way to get cash flow, and you can actually increase that cash flow and keep more of it by investing and living overseas. Today, I'm going to give you 2 strategies that you can use. And so even though I'm not a big believer in passive income, the money had to come from somewhere. Obviously, getting dividends from things like stocks is a great way to have an income that either helps you to run your business better because you don't need that money to live on, or if you are retired or just an investor, it's a great way to just have some cash. And so the Nomad Capitalist strategy of investing and living overseas can actually help you get there faster, invest a smaller portion of your portfolio into dividend yielding stuff because you earn higher returns by using our strategies. And so if it's your first time here, I'm Andrew Henderson, founder of Nomad Capitalist. We are a boutique consulting firm that helps 7- and 8-figure entrepreneurs and investors legally go where you're treated best, everything from reducing your taxes, having a second citizenship, just making sure that you are in control of your own life in these crazy times. And so let's talk about the 2 ways that you could earn higher dividend yields overseas. The first way is just actually getting higher dividend yields in other countries. And so one example that we have mentioned before and that I've seen for some time is in the banking space, for example. Stocks that are rather boring, probably not going to see, as big of fluctuations, and none of this is financial advice, by the way, but you're not going to see probably as big of fluctuations in a bank stock as in some, high growth tech stock. And so for someone who just wants a consistent income with less volatility, banking may be a sector you look at. U.S. banks, for example, you'll see 2.5%, 3%, maybe you'll see 3.5%. I think I saw one that was at 4%, and it kind of gotten beaten up. And so yields on U.S. banks just aren't that high. What we've known for some time is European bank stocks do pay higher dividends. You see some that are even in the very high single digits right now, like 8 or 9%. Some of those have gotten beaten up a little bit because of Europe's exposure to the Russia-Ukraine war. But European banks always paid higher dividends compared to what you'll find in the United States. Singaporean banks, for example, pay higher dividends. You'll get 4.5% or so. Banks in China listed on Hong Kong exchanges, again, have kind of gotten beaten up throughout the pandemic. You see PE ratios that are, ridiculously low. It's scary. But their yields are really high. Again, you'll see 8 or 9% yields. Some of those dividends may get whacked at some point. But you have always seen higher yields there, all right? And so you can look at, here's another example, forestry stocks in places that are listed in Singapore, for example. They're in Malaysia, they're in Indonesia. Maybe you don't like the sustainability aspect of some of the stuff like palm oil, but you're going to find 7, 8, 9% yields on some of that stuff. You wouldn't find that on an equivalent U.S. stock. You will find pretty high yields on certain like U.S. REITs that are investing in, let's say, medical space. That space is kind of getting beaten up for some reason the last couple of years. Office space in the U.S. I'd rather have, for sustainability purposes or for the sustainability of the investment, I'd rather have offices in emerging markets, places like Singapore, places like Asia in general, places where people are going back to the office. I see less of a movement to remote work. I see people like in our offices in Eastern Europe, we have people who are like, when is our office opening? We want to go to the office. And you probably wouldn't have that in the U.S. And I think that probably points to the fact that in some non-Western markets, I would rather have, in terms of a long-term investment, access to REITs that own office space, for example, in Eastern and emerging markets. That's why we invested a whole bunch of our money into actually owning offices in the places where we are. And so whether it's in forestry, whether it's in banking, whether it's in actual kind of REITs, yields can potentially be higher in those markets. Obviously, you've got emerging markets, for example. So if you want to buy Singapore-listed REITs that focus on India, it's a freehold country, you can get about 7% on a REIT there. And so you could say, hey, there's REITs in the U.S. that pay more than that. You could argue that the growth play in a country like India is higher than, again, buying an office REIT in the United States, and that it's more long-term sustainable. So actual higher dividend yields on things like banks, REITs, you can find that. And by the way, you can find plenty of high-yielding REITs in Asia and in Europe as well. But I think generally speaking, for the sectors that you might want to look at for yield, you can find higher yields outside of the United States. Is capital growth is good? I think in some cases it has been. In some cases it hasn't been. Obviously, again, Chinese banks in Hong Kong have gotten torched in the last 5 years. So for capital growth, U.S. banks have been a better investment. And obviously, banks that have gotten beaten up or stocks that have gotten beaten up, that those dividends may not survive. But for just general stuff, again, Singaporean banks versus U.S. banks, maybe in a better position in terms of yield. Now, the second strategy you can do to increase your dividend yields overseas is simply reduce the tax, and there's two ways to do this. So if you're a U.S. person, if you're a citizen, if you're a green card holder, you're going to be taxed on your passive income no matter where you live. You could potentially move to Puerto Rico, but in general, if you move overseas, that's not going to help you reduce your taxes. And certainly if you live in the United States, that's not going to help you reduce your taxes on a passive income like a dividend. However, let's look at the fact that certain countries, Singapore, for example, Hong Kong, they do not have a dividend tax. And so if you get that 4.5% yield on a Singaporean bank that's paid out from a Singaporean listed equity, they are not going to impose any tax. Again, same thing in Hong Kong. So a Singaporean, which has, if they're living in Singapore, they have no tax treaty with the United States, and they're just investing in a U.S. listed stock, they're going to pay 30% on that dividend. If they're going to invest in a foreign listed, like an Irish domiciled S&P 500 index fund, for example, they can cut that dividend down. But you are not going to have to worry about that at all if you invest in stocks, for example, in Singapore. Now, if you live in a Western country, you will be taxed on your worldwide income in that country. So if you live in Germany, they'll say, great, Singapore taxed you at zero. Whatever the applicable rate is, you can pay that to us because you live here, and we tax you if you live here on your worldwide income. But unlike the United States, which taxes you on your worldwide income no matter where you live, if you're German or Australian or Canadian, you can choose to leave. You can become non-resident for tax purposes. There's some steps to go through. It's easier in some countries than others. And by the way, there may be an exit tax. If you're building a portfolio, you want to make sure that you're out before you have a huge portfolio, or at least while the chips are down, if your portfolio has suffered some losses. But you can leave your country and you can move to a place like Singapore, for example, where you wouldn't have that dividend tax. You can move to a tax-free country. You can move to a country with a tax incentive where they don't tax you. You can move to a territorial tax where they don't tax your foreign source income. You can move to a country with a non-dom program where they're not going to tax money you don't remit to the country. And so there's any number of tax-friendly countries you can move to. We counted 28 plus Puerto Rico that would help both entrepreneurs and investors. And so if you're just an investor, there's even more, right? And so if you move to one of those places, you can potentially, in some cases, reduce your rate if you're moving to a treaty country, right? So if you go to a country that has a tax treaty with the country where you're investing, the dividend is coming from, you can potentially reduce the rate. So let's say your dividend tax rate in the U.S. Or some Western country was 20%, and you can move to a place where there was no additional tax, they didn't tax it because you have a tax incentive, and the treaty was 15, all right, you're reducing your rate. What would be even better, though, is if you were to invest in places where the actual tax at source was zero and your tax on a personal level was at zero. So you're kind of following my tax-friendly quadrant, which is designed for entrepreneurs. Where are you leaving? A high-tax country that has taxes on dividends. Where are you arriving? A country that doesn't tax you for whatever reason. Where is your investment? Your current investments may be in a place where no matter where you live, there's going to be some dividend tax. Where are you going to move those investments to? Perhaps part of the portfolio can be moved to a place that has no tax on dividends. And so you could go from having personal tax and tax on the actual dividend itself. Again, if you're in the U.S., it's just going to be one tax, but you're going to be hit one of those two ways at least. If you have to where you're going to be hit neither of those two ways, you could ostensibly pay 0% on dividends. And so if you look at, hey, I live in the United States and I invest in a bank stock and I make 2.5% and net it's 2%, something like that. And I move to UAE and I invest in through my Singapore bank account or through my brokerage account outside of the United States. I invest in a bank stock in Singapore, and I have no personal obligation, and Singapore doesn't take anything at source. And so I'm going from a 2% net to a 4.5% net, more than double my dividend yield. Obviously, you need to factor in capital appreciation. And in that example, unless you gave up your U.S. citizenship or green card, obviously the U.S. tax status is still going to follow you. But okay, let's say you move from Canada, you move from Germany, whatever. Theoretically, you could double your dividend yield by using both of these strategies. I'm not telling you to invest in Singapore. I'm not telling you to invest in Hong Kong. I'm not your financial advisor or a financial advisor at all. But what I'm saying is, as someone who has a dividend portfolio, these are the things that I'm looking at. And not only increasing the quality of the investment in terms of how much you're actually getting if you're seeking a yield, changing how much of that you keep. And you could also argue that the third pillar is, again, if you believe that long-term there's more sustainability in certain markets outside of where you live, that could be an additional way to make sure that you have a stronger investment. But higher yields, keeping more of the yield that you earn, two ways to keep more money from your dividend yields overseas and increase your income.